And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Frank Rotman, who's the co-founder and CIO at QED Investors with approximately $4.5 billion in assets under management. Frank, thank you so much for taking the time and welcome to the Smart Money
Ah,
Circle.
happy to be here.
So Frank, I always like to begin. Can you please tell us your story and how you got to where you are today?
Yeah, so my story is about doing one thing and one thing only for a really long time. I've been in and around financial services, banking, fintech, everything surrounding the financial services industry for about 31 years now. So the first step in my career directly out of college, I went to this tiny little regional bank called Signet Bank. And most people have never heard of it. And that's because the most important thing that Signet Bank ever did was spin out Capital One.
Yeah.
And that's really what I went there to do, was to help be part of the early guard that created Capital One. And I played a variety of roles there. So I was the first chief credit officer before there even was a title for it, and helped reinvent underwriting, which is what Capital One is actually known for today. Spent a lot of time in that area trying to, build the analytic infrastructure for the company and figure out, how to do something differently than the industry did before. But I also built businesses from scratch that the company needed or fixed some of the big businesses when they were broken. So I spent a lot of time as a P&L manager, and building things from the ground up. So did that for a number of years, and then left to build a student lending company and tried my hand at entrepreneurship. And it was so much fun that I just couldn't leave it. So after doing that, I joined back up with one of the co-founders of Capital One, Nigel Morris, and we started QED Investors. It's a boutique venture capital firm that focuses on fintech. There's a common theme here. I do one thing, that's all I kind of know. And the whole goal was to really play around in the early stage ecosystem, help founders who hadn't figured out their business models yet, hadn't figured out how to crack the code on whatever they were doing, and take our operating backgrounds and hopefully bring some capital to the table as well, and go on the journey with them. And unlike consultants where you could give advice and they can just kick you out, or you can tell them they didn't follow your advice, like you're kind of married when you give them a check and you're around the table with them. So, it was really about aligning and using the check writing as almost an excuse to play with the early stage ecosystem and help founders. So we started as Nigel, myself, and one other person from Capital One. We've now grown into a global firm with about 20 investment professionals. We've made close to 250 investments over the past 17 years. We have a number of companies that we're the first or second check in that are worth, many billions of dollars. A number of them are public companies that people have heard of. So that's kind of us in a nutshell.
I absolutely love your story, by the way, Frank. And I didn't realize you were so going so back to Capital One and you were that involved and had multiple businesses. So you understand the founder side of it or the entrepreneurial side of it, and you also understand the investor side of it. So I'm really interested to hear more. Can you
Yeah.
please tell us about QED and your investment strategy?
Yeah. So again, as I mentioned, QD is a specialty venture capital firm. I am amazed at how many venture capitalists that are so talented and so successful that kind of do a little of everything. The whole focus we have is on doing one thing and one thing really well, which is being subject matter experts across the fintech ecosystem. And that actually is more than one thing, right? Financial services is pretty broad. It's a big piece of the GDP of the world. It's everything from core banking to payments to lending to insurance to investments. Like it's a variety of different businesses underneath this big umbrella called financial services. So that's what we do. We really are operators masquerading as investors. Almost everyone on the team has some operating background, and we get involved to help kink the curve on the outcomes of companies. So our investment strategy is really to, find the emerging companies as early as we can, and be there around the table as an active investor, trying to be consiglieres to the founding teams. And hopefully with our backgrounds, we can help them, avoid some potholes and a lot of the mistakes that they might make otherwise. It means we can build our network very selectively, around the type of connections that we can uniquely provide, to the founders versus a generalist where, they probably have very different connections than we do across many different ecosystems. But I don't know how the generalists do it. I mean, I think I won't say I'd be terrible at it, but I'd be a lot worse at it than, starting with subject matter expertise, which is at least a crutch to fall back on.
No, I love it. It's a rule of one, right? Like do one thing, do it really well, master it instead of being the jack of all trades and the master of none. You're focused, you know your lane, you're staying in your lane. I love that.
Yeah. And there are some talented investors that have figured out how to be the jack of all trades. And I'm jealous of them in some ways because I don't know how they do it.
Fair enough. So, okay, beautiful. Let's talk about risk management. How do you handle risk, and what are some mistakes you see people make with respect to risk management, either from the investing side or from the operations from the founder side?
Yeah. I mean, look, you get paid for taking risk and the risk not materializing. Right? So it's not about avoiding risk. If your goal is to avoid risk, you end up doing nothing. And I think the most talented risk managers understand this at their core. It's actually about seeking risk, but it's about seeking risk where you think the risk return trade-off is warranted, right? But I can tell you there's so many people that I think are mediocre to poor, venture capitalists or, investors in general, where they can see how everything could go wrong. And that's actually the easy side of the business. It's very easy to sit on the sidelines and say, let me tell you everything that can go wrong. It's really about figuring out, is the reward justified relative to the risks that you see that could materialize. And, part of it is prognosticating the future a bit and getting comfortable that you think the risks aren't going to materialize, right? So being comfortable with risk is very important to being a good risk manager. And being uncomfortable with risk is a good way to do nothing.
Love it. That is really, really, really powerful. So, see, you're seeking risk, you're looking for asymmetric risk to reward, where the reward side is way bigger than the potential downside of the risk. And you're embracing risk instead of avoiding it. Like you said, you do nothing, then okay, there's no risk there, but there's still a risk in missing out, I guess. But yeah, you're not going to make the money if you don't take the risk. So I love that attitude and that angle towards seeking risk.
Well, a lot of the best investments are non-consensus investments, right? It's when you're non-consensus and right that you get paid a lot of money.
Yes.
Hopefully, right? I mean, if you're non-consensus and you don't get paid a lot, then it was not a great investment. But a lot of times when you're in a non-consensus space, people see risk that you might see but believe isn't going to materialize,
Yeah.
right? And understanding risk and fundamentally breaking down like what has to be true for a business to succeed, is really important. Understanding, are you taking operational risk, right? Like, can it be built? Is this a team that can actually manage the nuances of whatever it is to manufacture the product and sell it? Are they taking technical risk? Like, is there something that needs to show up from a technical standpoint that hasn't shown up yet? Or do they have to build something that's never been built before? Are they taking market risk? Like, do you know if customers want this, or are there enough of them that will show up and pay you enough to build a business? Are you taking regulatory risk? There are all these different types of risk that you can take. So, being aware of risk is actually pretty academic, so not that hard for a well-trained MBA to kind of tear apart something and say, let me tell you everything that can go wrong. The art plus the science, but the art of it is embracing that risk and understanding it fundamentally, and then understanding the reward system and whether it's worth it.
Yeah, that makes perfect sense. So let's talk about some timeless lessons, Frank, that you've learned along the way that you'd like to share with the audience.
Yeah, I mean, there are a lot of them. One of them is I think that the best founders and the best founding teams, they have a pretty common characteristic, and the characteristic is they're very good at falling in love with the problem, but not with their solution. And this is a pretty important distinction because at the end of the day, you report to the truth, and the truth you don't get to control, right? I mean, that's market forces at work. That's the
Yeah.
audience, whoever your ultimate customer is, gets to
Yep.
determine the truth. Either they want your product or they don't. Either they're willing to pay you for it or they're not. Either the powers that be will give you permission to have that product in the world or not, right? I mean, you don't get to control like the truth. You get to control execution. You get to control your learning agenda. You get to control a bunch of things that you put out into the world, but you don't get to control the truth, right? So the important thing is falling in love with the problem and not with your solution, because your solution might not be quite right, and the market might tell you it's not quite right. But so many founders have pride of authorship. They spend so much time thinking about their solution statement that they end up falling in love with that incarnation of the solution. And when if they fall in love with their solution, they don't have eyes wide open to the market telling them whether they're right or wrong, right? They might say, you know what, let's run another experiment with this because I think the market's wrong. The
Yeah.
market's not wrong. Like you might
Right.
have,
Right.
you might be getting feedback you don't like, but you don't get to determine whether they like your product or not, right? You can't just shove it down their throats and say, you have to buy my product and you have to pay me this much and you have to like it. Like we're
No
not
way.
in, we're not in a dictatorship, right?
Right. Right.
So I think it's common when you're really diligencing an idea, and we're in the private markets, right? So I mean, these are young companies that are still figuring things out, right? These are not big public companies that have already cracked markets. You're really running a series of experiments, and you have an idea, you have a problem statement that you think is profound, and you have a solution statement that you think might be right. And then it's about running the experiment as efficiently as possible, getting feedback and having enough degrees of freedom to fix it if you're wrong.
Yeah.
But when you talk about timeless advice, like the best leaders that I've ever met and the best people I've worked with just have this open mind where they have strong opinions held loosely, right? Like you have a strong opinion to move forward and do something, but if you're wrong, you're okay embracing the fact that you probably have to change things. You might have to fix it. You might have to listen to what's actually happening out in the market. So it's not universally true advice, but it is mostly true advice.
So that's really, really profound what you said. And I love the distinction there too. And the fact that you can't control the market. So let's talk about timeless mistakes. I'll just ask you that question and then I'll follow up afterwards.
I mean, timeless mistakes. Uh, to use like a normal way of thinking about it, it would be sunk cost fallacy. Like people really do get incredibly attached to the things they put time into. They get attached to the statements they put out in the world, the things they've told their teams. Um, the timeless advice that I would give, which is also one of the worst mistakes that people make on the opposite side, is you have to get used to being wrong. Like get comfortable. Like if I had to give advice to like the younger me,
Mm.
is I wish at a younger age I was comfortable being wrong. It's funny, like this is very common from young people. Like they just want to be right and they want people to know they're right and they want the world to know they're right and they want to tell everyone they're right. But the more powerful thing is being comfortable being wrong because then you can take more risk. And if the world knows that you're willing to actually admit when you're wrong, then they're willing to listen to you more. So when you talk about timeless advice, it's kind of ignoring the things that are around you because you have sunk cost fallacy and you get attached to the things that you've said or done. You got to throw it out the window. I mean, what really matters is either building something big or investing in something good. I mean, change. Like I think it's a Japanese saying that if you find that you're on the wrong train, the best thing to do is to get off at the next step, the next stop, right? Like that's what you need to do. And to be able to do that publicly, that's the hard part.
Yeah, I couldn't agree with you more. I love that. The getting wrong, getting used to being wrong is so, so incredibly powerful. All right. And the sunk cost fallacy too, for those that don't know, it's just basically you saying, hey, listen, just because I've been going right or I've invested all this time in going right, I'm going to keep going right. Even though, hey, it doesn't make any sense anymore. New data arose saying the market tells you to go left or go up or go down. No, I got to go right. My blinders are on. So that's what the sunk cost fallacy is there. I love that. And okay. So next question for you. Let's talk about leadership. What makes a great leader, Frank? And what are some lessons you've learned about leadership that you'd like to share with the audience?
Yeah. So, I mean, this is the type of question you could go on forever about. Yeah, because there is no one type of leader, right? And anyone who tries to mimic themselves around someone else, I mean, it's just hard. You've got to figure out what works for yourself. And a lot of times it starts with figuring out what your superpower is and organizing around your superpower and then surrounding yourself by people who can, complement you and fill in the gaps, that you have. Because I mean, most talented leaders are actually quite spiky. They're incredibly good at something, but almost definitionally, it means they're pretty bad at something else. I could give you the laundry list of all the things that I'm bad at, and I'm very self-aware of it. But I think good leaders are, and they surround themselves by people and are willing to make others accountable for and give them the authority to make decisions around, the things that they aren't the right people to own, right? The great leaders actually understand that you can only hold people accountable for things if you give them the decision-making authority around those things. Great leaders understand that you solve things that you organize around, right? So there's a lot more organization and thought about how you structure teams and accountability and the structure of what you're going to tackle as an organization that ultimately cascades through the organization. I mean, ultimately, a lot of people don't like to think about this because they think of leadership as a people skill. But the reality is, like, a lot of leadership is about being a good asset allocator, right? You have to be a good communicator as well, but you're really ultimately like the decisions that you're making are about being a good asset allocator. And if you wanted to boil the ocean into like the things that you allocate assets into, you're either building something, you're testing something in the market, or you're originating customers and serving your customers and capturing economic rent in doing it. Like those are kind of the three things that you do with money and people. So being a great leader is being incredibly organized and being very thoughtful about where all of your people, all of your money go to. How are you organized around that? How much are you learning for how much money, how quickly? Do you have an organization that if it's spending money well, it knows how to raise its hand for more? And if it's spending money poorly, it knows how to say, let me give some back, right? Like if you are a good asset allocator, then you can become a good leader. There are people skills that go along with it. There are communication skills that go along with it. There's, talent assessment that goes along with it. But at the core, if you want a successful team, you ultimately have to start and end with being an incredible asset allocator.
Frank, I think that's absolutely brilliant. I don't think anyone's come on the show before in over 22 seasons now and years and years of doing this and hundreds of guests and saying, hey, leadership is about asset allocation because most people look at asset allocation from an investing standpoint. Should I invest in gold, stocks, blah, 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 blah. You're saying no, leadership itself is asset allocation, and it is because you have to allocate, like you said, the three buckets. You're going to build something, you're going to go sell it. Does it work, not work, test, adjust, and then service the customers once it's actually up and running, and then grow and so on and so forth. But also allocate your time and allocate your resources and allocate everything else. So all those are assets, right? So I think that's absolutely brilliant on the asset allocation part with leadership. So next question for you. Let's talk about adversity. What are some obstacles you had to overcome, and how do you handle adversity?
Yeah, this is an interesting question. Many times in my career, I was on the verge of getting fired. And I mean, I did a lot of big things. I mean, a lot of what Capital One is has my fingerprints, on it from being there early. Like it's not just about me. It's just when you're someplace early, you tend to shape the organization and the things that it works on. It's natural. So I'm not taking more credit than credit is due. It's in some ways being lucky for being there early. But, on this path of taking a lot of accountability for some of the biggest business units of the company and building them from the ground up, made a lot of mistakes along the way. And with those mistakes came adversity. And with that adversity, like I almost got fired a number of times for stepping out ahead of myself and what the organization actually needed. And, what I realized is, uh, ultimately, you are trying to, if you are trying to accomplish big things, uh, you have to be incredibly thoughtful about playing a multi-turn game, not just playing a single turn game. Like this is not about a transaction when you're trying to do anything that's very large, right? And a lot of people, especially when you're young, I was very young and put in positions that I was not actually capable of doing. There's no one else to do it when you're growing a startup from the ground up. But a lot of times you think about the decision that's in front of you as an independent thing where you want to do the best thing right now, right? Like there's a right answer and a wrong answer, and you see it so clearly. And again, I think these are the mistakes of youth. You see things probably a bit more black and white than it really is. And you try to optimize the decision and you get really attached to it. And the problem is you're really playing a multi-term game, right? Everything you do has a response that comes afterwards, and that response is stimulus for something else to happen, right? So it's this constant game of thinking very, very far into the future and then backing up, right? So it's, the best people can think big and then think small and think big and think small, and they can have this context shifting. So a lot of the mistakes that I made in adversity that came with it was from wanting to be right now and make the decision that just seems so
Okay.
obvious right now, and the ripple effects of other people trying to tell me I was playing a multi-turn game and I just was not listening. So I actually almost blew up Capital One more than once
Oh,
with
wow.
some of the decisions that I made. Um, there was one decision that I made where the organization was telling I'd found an insight, right? The team had discovered something that was really powerful, and we looked at the market opportunity and we said we want to seize it. Like this is what you live for when you're building a startup. You get the positive feedback from the market that they liked something from a test. You stare at your theoretical spreadsheet about what you think you can do, and you're like, holy crap. Like I literally have just discovered gold. So how do we take advantage of this? And the aggressive young me wanted to just ram a hole into the market and just own this market like overnight. And the spreadsheet told me I could do it. I mean, spreadsheets are fantastic at doing that. You put the numbers in and you calculate formulas and it works. But did the analysis and it said there's this giant opportunity, go seize it. The organization was giving me not so subtle hints that we were not prepared for it. And that if I went after the opportunity as big as I wanted to, as fast as I wanted to, I was going to blow up the organization.
Wow.
To me,
Wow.
that was the wrong answer, right? We just did all this work to figure out the market wanted something. And the market was telling us, like, if you put this out there, we will buy it. And the organization was telling me, we're not ready for it. And I said, that's not acceptable. So I was playing a single turn game where I'm like, look, let's put this out in the market and that will give us this is back in a day when, direct mail was the way that you found customers. So when you pressed the button on the machine, it's not like tomorrow the customers come in. Like you start the machine up. It's actually a very slow machine. You had to talk to print vendors and you had to get things printed, and then you had to go to data, and have these tapes cut that go to the data vendor. So, it was months before when you press the button, like the actual customers would start showing up. And I just figured we would solve it. Like with a couple months notice, 3, 4 months notice, like we would figure out how, from a capacity standpoint, to be able to deal with this market opportunity. And I didn't listen to my team.
Wow.
And they were closer to it than I was. And I was like, I guess you can call it gold crazy. I mean, you've probably heard that from people who are treasure hunters, right? But I just saw it and I wanted it and I didn't want no. So I pressed the button. And the organization did everything it could to try to fix the problems that we had from a capacity standpoint. Because by the way, like you would put direct mail out, direct mail would come back. You then had to do data entry and you needed people, and like it's not as automated as it is today, right? Where you can just scale things with cloud capacity. Like there were tons of people involved. And the good, the bad, and the ugly of it was not only did we get the response that we thought we were going to get, it was better than we thought. At a time
Wow.
when we didn't have capacity to do what I even thought we were going to get. Like, so the market opportunity was there. And it ends up in 1 month, we ended up booking about 750,000 customers into a brand new product where the most we had ever done the month before, the months leading up to that was about 10 to 15,000 a month. So we went from 10 to 15,000 a month to 750,000 in 1 month. And we were flirting with basically breaking the law from a compliance standpoint about being able to get the cards in people's hands in the time that we had committed that we were going to. We just weren't able to handle it. The organization had to spin up a third shift of people opening mail from midnight to 8 o'clock in the morning. Executives became data entry people. I was actually on scanning machines. Like, I mean, it was all hands on deck trying to figure out how to light up like new data entry vendor in Puerto Rico while we were dealing with all this mail that was coming in. So, I mean, apologies for such a long story, but like the adversity came because it was self-inflicted, right? I mean, there's no one that was telling me I had to take advantage of that opportunity all at once. I mean, we ended up working our way through it, and a lot of people will say, "See, you were right. I was wrong." Right? I mean, I stressed the organization out. I could have spread it out over a couple of months. It was about playing a multi-turn game. The organization then did not like me for a while. There were a lot of people who were away from their families doing things because of this fire drill that I caused. We had a picnic not too long after that, and I volunteered to get a dunk tank, and there were a lot of people who were very happy to dunk me. Um, but it's a statement where I lost a bunch of credibility points with the organization that made it hard to do the next thing. It wasn't about did I succeed on the thing. It made it harder to do the next thing. Because now the organization knew that I was willing to take undue risk and I was willing to push them to do things that they were telling me that we shouldn't have done. So again, I can kind of pause the story there, but the adversity was hard learning for someone who was young and aggressive and trying to just report to the what I thought was the answer that the spreadsheet gave me, and it's not always true.
Yeah, that's so, so powerful. And it's almost like consequences. There's short-term consequences and long-term consequences. And short-term, it feels good to eat the cookie, short-term gain. But over time, if you eat the cookie all day, every day, nothing else, you get pain long-term. So you got to be really careful with the consequences. And I love what you said there about looking at the whole picture, the 360 view. It's not just about one thing and not worrying about everything else. So that's really, really powerful. Final question for you, Frank, is what's the best piece of advice you like to give the audience or your 30-year-old self? You gave it to us earlier, but feel free anywhere you want to go.
Yeah. I mean, again, to my 30-year-old self, it's the same advice I said before. It is the main advice I can give people is the earlier in your career you can get comfortable just admitting you're wrong and being able to publicly declare that, you know, I had a strong opinion. There's new information that came in. Like I can adjust my opinion. I think the world would be better if people could do that rather than being tribal and, just adhering to opinions just because now it's part of their identity. So I think that's a big piece of advice that I would give pretty much everyone. Um, I think uh, being a student of all of the different styles that are around you is another piece of advice that I would give, where you can learn by being thrust into different circumstances. You are not the hero of your own story. Like at the end of the day, like this is a story being told with lots of people in it. Everyone behaves differently. There are things you can learn by just being a student and observing how people behave. And if you recognize that like they are different and they make decisions differently than you do and they see things differently than you do, the more aware you are of that, the less you'll try to thrust your way of thinking upon them. Right. And just being aware that like not everyone processes information and makes decisions the same way. And just telling people your solution louder is not the answer, or telling it to them over and over and over and insisting that you're right. So a lot of it is just being a student and observant of other people. Um, being accepting of the fact that your logic is not necessarily their logic, even though you think it's logic. Therefore, you can out logic them, to getting to answers. The world is just much more subtle than that. And this is coming from someone who, people who know me well, they call me the closest thing to a robot that they can find. Like I am a first principles thinker. I collapse everything to basics and then build them back up based on the atomic building blocks and then put frameworks in place. Even I understand that, like, that's how I think. And I can use that as a superpower to try to explain things to other people. Might not work. They might have a completely different way of approaching the problem. And I just need to slow down for a second, listen to them, process what they're saying, and try to internalize that there might be a different way of looking at the problem. And then hopefully we can create common ground.
Love it. Absolutely love it. Well, Frank, this has been absolutely fantastic. Thank you so much for taking the time, and hopefully we'll have you on again soon.
Happy to.